How's it going, fellow traders? It's Magic Trader here, and this is the CFTC report for November 21st. The report came out late because of the holidays last week, so the report data was released this past Monday. So I put a report together, and here's a snapshot of the data that was reported for the major currency pairs in the US dollar. So let's get down to it and take a look at what the institutions are doing. So in terms of gold, what do we see here? So we see that institutions are still with a bit of an aggressive long bias, sitting at 272,000 positions, right? And shorts drop, right? They were sitting at 75, 76, 76, and then boom, they dropped their short positions from 76,000 to 71,000. Now remember, this comes as price is rallying up here. So price rallies, they don't increase longs, but the cause of that rally is because shorts are closing out. So that's an important thing to remember here, right? So yes, we have a monthly demand zone in control that hardly made a 2-to-1 move away. But this last push upwards was not caused by demand being filled. It was more that shorts were being closed out. Alright? So what happens is, because the shorts being closed out, long exposure jumps up 1 point from 78 to 79%, bringing the net positions from 195 to 201,000. So there's no doubt here that, you know, the bias is long, right? But we also have to remember that we have this here to contend with. You know, when price does get up here, it's going to drop because there's supply here. This is supply from the institutions. So when price does get up here, it's going to drop. So there's going to be some consolidation in the coming weeks before we see a larger move to the upside, which is what we're thinking is going to happen here. But right now, this isn't the strongest sign that price is going to move upwards from this area. I want to see demand being filled and shorts being closed out, so that I have a stronger sense that that's the good place to get in, because that's where the institutions are getting in. I want to get in where the institutions are filling in demand, because if they're not filling in demand at those areas, why do I want to fill in demand there, right? If they're not filling in demand at those areas, then that means when price comes back to those areas aren't going to hold. So why do I want long orders sitting there? No way. No siree, Bob. So let's go to oil. So what do we see with oil? They close out some of their longs from 778,000 to 742,000. So a decrease in longs as we consolidate within this weekly area of supply. But take a look here, the last 2 weeks, right? Massive closures of short positions right here at the weekly supply. Closing shorts. They're not expecting a big drop. So they're closing off shorts. In the meantime, long exposure jumps up another point to 82%. And take a look at the coloration of the cells. Nice bright green. This is exactly what we like to see. And net positions dropped slightly from 596,000 to 577,000. But despite the small drop in net positions, because shorts are declining so heavily, long exposure goes up 1 point, and that means they're even longer, even a stronger longer bias than the previous week. So a daily demand zone's been hit as price dropped from that weekly supply, which, you know, we've come to learn is a very, well, we didn't come to learn it, but upon analyzing the weekly supply, we can see that there was a lot of trading in that area. So therefore, you know, the institutions had a lot of time to fill in orders. So meaning when price gets back up to these zones, is there really a lot of supply to be filled in from the institutions? Probably not. So we're reacting from a daily demand. We're pushing upwards. I'm waiting to see what's going to happen. I'd like to see that weekly supply area being taken out, because This is like a 3-month bearish engulfing. That's holding price. So 3-month bearish engulfing. You know, eventually this could eventually just stall price out and cause a bigger drop to at least that weekly area of demand. It's possible. So I'm watching, I'm waiting, I'm not in a position yet. I do want to get in long, but right now I just don't see the good opportunities. Alright, so let's take a look at US dollar. So this one's been a very difficult chart because a lot of craziness is happening on these charts, right? It's like we're floating in the middle of the ocean. You could just sail in any direction. The wind keeps on changing direction, so it's hard to pinpoint what areas price is going to be moving towards. Excuse me, I have a bad cold that I've been fighting. So what I can tell you is that with this area here, when price was dropping, they were closing off their longs, from reducing from 27,000 to 22,000. All right, and during that process, shorts were just closed off by about 1K, not a lot. So price is dropping and they're closing shorts. So could be some profit taking, right, from positions placed up here. Profit taking. So in the meantime, what ends up happening is short exposure jumps up from 52% to 56%. Now that's what we want to see, right? Net exposure, net positions jump up from negative 2,000 to negative 6.5 thousand. You know, as you can see from my arrows, I'm expecting price to drop even further, right? So these are good signs for that. And remember, when positions were at 50-50, our indicator wasn't telling us that they had a neutral bias because they were 50-50. Our indicator has been telling us that they've been bearish this whole time. Never changed its mind. So powerful stuff using this indicator and how the colored cells are created. So so longs being closed out, longs are cooled off, longs are below 3-month average, shorts are aggressive, sitting just below 3-month average but aggressive. Longs are cooled off, shorts are aggressive, bias is short, net positions negative. So I'm seeing a bigger drop. This area here, this weekly demand is not the greatest looking demand. And when you break it down looking at the daily chart, that daily structure is a complete mess. So when things are a mess, that means there isn't a clear story being told by the institutions. When things are a mess, that means nobody knew what they were doing at that point. Up, down, left, nobody knows what's going on. Alright, so when you see that, that means there isn't any significant amount of orders sitting at those areas. So when there isn't any significant amount of orders, that means you don't take trades, period. Unless you want to lose your money, or unless you want to risk your money. It's like going to the casino. You don't know what the outcome is, so why would you put your money on it, right? So I want to see clear zones. I want to see clear areas that the institutions are filling in their demand, and I want the COT reports to support the fact that those are the areas that the institutions are filling in their orders. That's where I want to put my money, because you know, you have the odds in your favor. So so yeah, all signs are of a weaker US dollar. And that's it. There's not much more to see here. I'm going to stick with that. All right. Aussie. So longs increase. That comes as price drops down right into the monthly demand imbalance here. Price drops into the monthly demand imbalance. And institutions add longs, right? But they also added shorts. Why? Well, because you need shorts to drive price down. So what ends up happening is long exposure drops from 72% to 67%, and net positions drop from a positive 44,000 to a positive 39,000. So they're still long biased here, right? We've been long biased for quite some time here. In June, the indicator turned long biased. And that was May, June, yeah, long biased. All throughout here. All right. So still still holding at 67%. So we're up there. Still long bias here. Shorts are cooled off. Longs are aggressive. But I do want to point out one thing. Shorts are above 3-month average. Longs are below 3-month average. Okay. Now, that could be, because of this drop, right? We hit a weekly supply, we're dropping. So you need to be more aggressive with your shorts in order to get down to these areas of demand so that you can eventually fill. What I'd like to see is demand start to kick back in here, right? I want to see these numbers get back up to these areas here. See how aggressive they were here? You see the coloration of the cells? I want to start seeing darker cells. And I want to start seeing lighter blue here. And when we start seeing bigger numbers here, then I'm going to be very happy. I want to see this weekly area taken out. And then I'll take longs. Like that. Alright, so let's go to the next one, US CAD. This one's also a little bit of a difficult chart because if we're expecting all this weakness to come in on the US dollar, then we'd expect weakness on this chart as well, right? But here's the deal. US dollar has been showing some weakness after it reacted from that weekly area of supply, or before hitting that weekly area of supply. We hit the weekly imbalance here, and the drop hasn't been nearly as significant as what we've seen with the US dollar. What do we see? Weekly bullish engulf, weekly bullish engulf, right? So that tells me this wants to go up. And if you look at the technicals, it wants to go up here. Plain and simple. It wants to go to this area of monthly supply, because it caused the removal of this area of demand. So there's supply there. Institutions filled in so much supply here that it was able to drop price so hard that it was enough to drop price, remove demand, and now they want to retrace it up to fill in the rest of their orders to take price lower. So that makes complete sense to me when I'm looking at the charts. Okay, that makes complete sense to me. Only thing is that if the US dollar starts to become weaker now, what's going to happen here? We still have a monthly downtrend with a monthly 20 EMA. So we could see price stall and eventually change over to the downside. That's a possibility. Bottom line is longs are cooled off and below 3-month average. Shorts are aggressive, below 3-month average. Coloration of the cells are red. 75% of the overall exposure to the institutions are geared to the short side. Net positions are at minus 45,000. So clearly the bias here is shorts. And so, would they be this aggressively short if price still needed to come all the way up here? Hard to say. Very hard to say. My intuition and my experience tells me no. They would start to be aggressively adding longs at this point if they were going to push price up there. So it's hard to say. It could just turn over right now. So this is going to be a learning experience for me. I'm not trading this pair right now because there's just nothing clear on these charts. There's nothing clear in this story. So I'm not going to get into a confusing story and try to figure everything out. Alright, so US Swiss. What we know is that a monthly area of supply is in control, and we got that move to the downside that we were expecting. And now we have a weekly area of demand in control, and we see that longs are becoming ever more aggressive, but we also see shorts slightly becoming aggressive. Longs way above 3-month average, shorts slightly above 3-month average. 71% of their overall exposure on this pair is to the long side. And net positions move up 2,000 to positive 29,000. So, are we going to see a bigger move to the upside? Maybe not. What we could see is another push upwards to these highs here before a bigger drop down. That's possible. Monthly supply is in control, right? So when a monthly area of supply gets into control, we don't just see a move to the downside within a week. It takes time, right? We're talking about a monthly chart. Each candle takes a whole month to be created. So if it took a whole month to create this supply area, or 2 months to create this supply area, then we should expect weeks to unfold before things play out in response to that area of supply. So again, there's nothing clear on this chart, so I'm not taking any trades on this pair, so I'm passing on it. The euro, what we can see here is with this candle, this ERC candle, the institutions closed a bit of their longs from 200,000 to 195,000. Closed off longs. Why? Maybe because they were pushing price right into a weekly supply area, so they knew that there was going to be a stalling action there. Shorts closed off as well from 115 to 110,000. So profit taking from shorts added here. Drops. So closing shorts means you need demand, which causes price to move up into a tested area of weekly supply. Bottom line is longs are above 3-month average. Shorts are just sitting below 3-month average. 66% of the overall exposure from the institutions are geared to the long side. And net positions move up about 9,000 to a positive 95,000 positions. So I'm expecting price to move up here like this. A very weak area of supply. A new weekly area of demand formed here. Price can drop down and do that. That's a possibility. But the fact that this is such a weak area of supply and it's now entering into the second test, it's just a matter of time, in my opinion, that this breaks and we see a bigger push to the upside. Okay, so let's go to pound. What are the institutions doing here? They increase longs, and that happened as price started to continue to consolidate off the weekly 20 EMA in preparations for a move to the upside, which we see right here, right? This candle right here. So longs, they increased longs from 53,000 to 58,000. At the same time, they roughly kept shorts the same. They added slightly, but nothing significant. Long exposure went from 48% to 50%. But again, coloration of the cells have never changed. They've been green this whole time. Bullish indication. Even when long exposure was at 46%, still bullish. So negative 300 positions. So slight bearish bias, but really we still know that it's bullish. We're reacting from a weekly supply structure here. So a move to the downside was to be expected. Bottom line, aggressive longs. Shorts cooled off. Biases to the upside. So here we have the US dollar Japanese yen. So this candle here, as price drops from the tested weekly area of supply and the descending trend line, what do? They close off longs. Good decision, right? Some profit taking on some long positions. But they also close off shorts. Over the last 3 weeks, they reduced shorts from 54 to 49 to 44,000. So if you were expecting a big drop, why would you be closing off shorts, right? So this is a little bit of an issue, because if we are to believe that the US dollar is going to drop, so a lot of weakness in the US dollar, what does that say about this pair? Shorts are at a supply zone and they're closing off shorts, reducing shorts from being aggressive to being cooled off. Long exposure sitting at 79%. Look at the coloration of the cells. I mean, that's pretty significant, right? Net positions 122,000. That's very bullish biased. Very bullish bias. So, we reacted from a 6-month demand, rallied up, hit a 3-month supply, dropped down. We're actually hitting a 3-month bullish engulfing area. So it is possible that we start seeing a move to the upside. So this is going to be a learning experience for me, because we see the pound going up, the euro going up, so that excuse me, so that leads us to believe that the US dollar is going to be weak. So if the US dollar is weak, why is the US dollar Japanese yen strong? Right? Why is the Kiwi, why is the dollar Swiss strong? You know, that brings a lot of things into question. You know, you look at the Aussie, it looks strong. You look at the Euro, it's strong. Pound is strong. Kiwi is going to be weak. It's the only one that's not in alignment with those other ones. US CAD. US CAD is weak. US dollar somewhat weak. US dollar Japanese yen strong. And US Swiss franc strong. So, you know, a lot of things not lining up here, and I'm not liking it too much. So these ones that are not really lining up perfectly, I'm not taking any trades off of them, because it's just, again, you know, there's no clear sign here. This one says long, but I don't see any areas to go long. You know, we have a weekly area of demand here, but this is very questionable of what it accomplished and all sorts of stuff. So it's not, you know, if I had to take a long trade, it would be down here. But like I said, it's not the clearest scenario, so it's difficult to read this one. So for now, I'm just going to learn from it. We'll continue to follow on a weekly basis and see what the institutions are doing. Right now, they're long biased. Kiwi. So, Kiwi, let's see, with the Kiwi, we see that they increased longs from 18 to 22, and that comes as price drops into a weekly area of demand. So again, what was the other pair that dropped like this, where they added shorts and longs? Can't remember, but I mentioned it on the video. So adding longs as price drops into weekly demand, adding shorts to get price down there, but 61% of their overall exposure is geared to the short side. Net positions negative 13,000. Shorts are aggressive, longs are neutral, shorts are way above average, longs are about average because, you know, we're pushing up from demand, so makes sense. I have a short bias on this one. I'd like to see some kind of a momentum shift up here, and then I'll take shorts. Okay, but we are on the underside of this trend line, so price can just consolidate here and then move downwards. Okay, so that's pretty much it. I hope you will find this video informative and help you with your trading. And until next time, trade well.